So we certainly intend to take it up in the coming year. So we will ourselves not violate any spirit of the law. You can interpret the. We never display investigation reports. We never display investigation reports. We only display orders. We will follow the advice of the Supreme Court. Whatever the Supreme Court has said, we are duty bound to follow. That's right. We will respect the orders of the Supreme Court. Why? Is that what the Supreme Court order said? So we will follow the letter and spirit of the Supreme Court order. That's not part of the, there's no public sharing as per the Supreme Court. That again is going into the realm of status of the investigation. And now that we have the press release in hand, so I would request, of course, I know that you will want to send that off, so we're quite happy to be silent for a few minutes while you send off whatever you need to send immediately, and then we can start again.
Hi, can some press releases be distributed this side also?
Madam, can we take a policy question? I mean, can you take a policy question?
First of all, this time we created an index for you because we realized that we have so many substantive matters, so it's useful. So the reason we first focused on the ESG related matters, as you know, this is an area which is very significant in the global markets. India's ability to attract capital is going to depend quite a lot on this issue. It is a very, I would say, nascent area where many jurisdictions are actually still at somewhat early stages of determining the path that they want to take. We've had numerous discussions on this in IOSCO. And I must share with you that in our IOSCO meetings, many of our peers who are there, the regulators, the capital market regulators, they have been quite amazed at the progress that India is making in this space. And when they asked us what the secret sauce was, we actually said the secret sauce was not so secret because every single piece of what we have done has been co-created with the market. So whether it is the ESG proposals that you will see today, which I will take you through, or it was T+1 implementation, you know that we are the first major market in the world to implement T+1, or whether it is swing pricing, which we are one of the few jurisdictions that has a very robust framework for swing pricing. All of this has been co-created with the industry through a very rigorous process of consultation and co-creation. I think we go well beyond consultation to a process of co-creation. So right at the start, if we look at ESG disclosures, I think one of the very important things that we are doing today is introducing the concept of BRSR core, which really means it's like a core ESG. And if you look at the numbers, the normal BRSR reporting that we had outlined, which was in line with the global norms, has about 800 parameters. Naturally, many corporates expressed difficulty in being able to do that in a rigorous way, first of all, to disclose, and then more importantly, to have assurance on 800 parameters was a very, very difficult task. So what we did was we sat down with the industry and co-created something called BRSR Core, which has a sum total of only 41 or 46, 40? 49 parameters. And above that, there are few, but those are all derived numbers like the intensity ratios. So it's been brought down to under 50. Not only that, in terms of what is the manner in which assurance will be given on each of these parameters has also been articulated. Guidance has been given on that. And that guidance was approved by the working group only after it was back tested. So there was a proposal that these will be the parameters. This is how we will give assurance. We went out and back tested it with a set of 10 large conglomerates. Only when it was clear, and there were some changes because of that, right? Because when the feedback comes that when you actually implement on the ground. So with that, we now have this very powerful tool called BRSR Core. And this is what will take us into the realm of assured ESG disclosure and therefore assured ESG ratings far ahead of any other jurisdiction on the planet. So this is a very important move for us. The other collateral benefit of the core BRSR was most jurisdictions are again struggling with the issue of supply chain ESG. So upstream, downstream, suppliers and dealers and so on. Everybody knows and understands that there's a vulnerability there to greenwashing because if an entity is wanting to develop a good ESG score, it can simply outsource either upstream or downstream the aspects of its activities which are not giving it a good ESG score. So it's very easy to circumvent this and it can result in potential greenwashing. So therefore we are saying we must bring in the supply chain, but because the supply chain will naturally consist of smaller companies, we must bring it in only for BRSR core, only these under 50 parameters. And more importantly, we don't want 100% coverage. So your top suppliers until you reach cumulatively 75%, your top customers until you reach accumulated 75%. So it's much easier to comply. So there's a huge ease of doing business here, but at the same time, you are achieving a high level of assurance. So this, again, we think is a very significant move that we are making, and we think that a large number of people are looking forward to seeing how this will work. Also, just to highlight that in the core BRSR, we have incorporated certain aspects of ESG that are extremely relevant to emerging markets. So traditionally, since this space has come from the developed markets, many of the emerging market relevant parameters were never included. We have now included them. And again, we find that when we speak at international fora, many of the emerging markets are looking forward to seeing what is it that we are doing in this area. Then moving on to the issue of the ratings themselves, we believe that this needs to be a regulated area. As you know, globally, before the 2008 crisis, credit rating agencies were also not regulated, and many people had said to us that, you know, global best practice does not require credit rating agencies to be regulated. After 2008, they all changed their mind. So we believe in not allowing a problem to first blow up and then only address it. We think that it's important that there should be, right from the start, a regulation and a way in which these entities conduct themselves. It is, again, very much a disclosure-based and a code of conduct-based approach. But yes, they need to be regulated entities. In terms of ESG investing, again, we are all very conscious of the fact that more and more money is flowing into these funds. Risk of greenwashing must be minimized. And therefore, we are introducing two things. One is, again, facilitating the growth of this market. The mutual funds, as you know, have restrictions on how many schemes they can launch. So up till now, there was only one possibility of launching one ESG scheme. We've now created ESG as a category. So within that category, there are now almost half a dozen different approaches to ESG. So in short, you can have more variety of ESG schemes going forward. So this is a developmental effort which is going to happen. But at the same time, there is greater emphasis on disclosures so that there is the investor, when they are investing in an ESG scheme, they know exactly what they're putting their money into. The second part is a linked proposal, which, as I said, is the framework around which we are saying that the ESG rating providers must be governed. So there must be transparency in terms of their rating rationale. Conflict of interest, very important, because as we know, the audit firms in the past have come under tremendous scrutiny on account of conflict of interest, that on the one hand, they have assurance type activities, and on the other hand, they have consulting type activities, and the two are not really separated in a meaningful way. So right at the start, we are wanting to make sure that that doesn't happen. So these rating providers can provide ratings and assurance type services, but they cannot then go and have a conflict of interest in terms of consulting. The third is also very important, particularly again from the perspective of India and emerging markets. You can have a ESG rating, which is a static rating, which is based on today's situation. But in order to facilitate the flow of transition finance, and particularly economies like ourselves need that transition finance to take the entire industrial sector from point A to point B. And therefore, the way in which we have structured what the rating agencies will do will also facilitate the creation of a rating which will facilitate that funds can flow into an entity for the specific purpose of facilitating transition. Lastly, of course, as I said, because we're now bringing in BRSR core, we will perhaps be the first country in the world to have ESG ratings which are based on assured data. With that, we'll move on to the secondary market. So we had said many months ago that we will come with an ASBA-like facility for secondary market trades. It's now going to become a manifest reality. Of course, system changes are needed. So the implementation date is a little bit away, but practically all the modalities have been ironed out. This has been once again co-created with the brokers and with the clearing corporations and the exchanges. So at this stage, we envisage that it will be optional both for the brokers to offer to their investors as well as to the investors as to whether they want to avail or not avail of this facility. But we hope that like ASBA did, and it picked up popularity so much, we hope that once the system stabilizes and people start to see the benefits, and some of the top brokers, because we know there's a fair amount of concentration, right? The top 10 brokers account for, I think, almost 70% of the customers in terms of retail. So we hope that the transition will be rapid once we actually get implemented. But this, we think, is another very important milestone in the way in which trading is done in our country. Again, I must share with you, fresh out of the ISCO oven, that global jurisdictions are just amazed. You know, everywhere else in the world, the model is a B2B model. The exchanges or the clearing corps talk to the clearing members, and it stops there. We are perhaps very unique. We don't have omnibus accounts. We don't have any of that. And the entire chain is completely visible and transparent thanks to the technology. So I've started now referring to this as really the India market stack, because nowhere else in the world is there a market stack in terms of technology which allows for us to go from B to B to C. And for crores and crores of investors, you know that we had implemented the pledge repledge system for securing and protecting the shares of the investors. We are now on this, I would say, very important point where we are now going to protect the cash of the investors. And therefore, you're going to see that our India stack in terms of markets is going to be, again, a world-beating stack, barring none. The second thing in the secondary market is a complementary proposal which relates to upstreaming of client funds. You know that typically client money goes and resides with the intermediaries, the brokers, in the form of pool accounts. We had recently implemented a regulatory provision where once in a quarter on the same day, all the money had to be returned to the clients. And you recollect that it was, we ourselves were shocked when we saw some of the numbers. And then we realized just how much money is actually sitting in the system. And again, it brings to light how in many parts of the world today, for instance, many regulators are worrying about the funds which are lying with broker dealers. Okay, it's become a topic of discussion amongst regulators in terms of systemic risk. And here we are, where we are saying that we are now going to have zero systemic risk on account of this, because all the money of the clients that comes into the broker network will get upstreamed to the clearing corporations, will get lien marked into the clearing corporations, and we will no longer carry that risk at all. So again, landmark in terms of the way in which our technology will work. While we were in the process of designing this, and as I said, co-creating it with the market, we came across another very interesting facet, which we have put down for our next year's KRAs, right, Anand? Next year's KRAs, which is that we want, it's a bit like saying portability across, you know that many investors have been asking us for portability across DPs. We think there is also a requirement for portability across clearing corporations, because while we are very focused on mitigation of cybersecurity related risks, these risks are a reality in today's world. We cannot underestimate them. And therefore, the need to think about portability across clearing corporations is also important. And if we have to have portability across clearing corporations, we must have portability of the collateral. So the collateral which is lien marked to clearing corporation A should be instantly transferable in terms of lien marked to clearing corporation B. And that mechanism we are now going to take up. And that's, as I said, a KRA for next year, that how we're going to work that system. And that will de-risk us even more as compared to where we are today. The next one, again, continuing in secondary markets, is about amendment to the stockbroker regulations to bring in a provision which casts a responsibility on the brokers to actually monitor for fraud and other market abuse. Now, the roots of this provision and this thought process actually came to us from the industry, from the brokers, where they shared with us some of the best practices that they are following already. Okay. And I would just like to, by way of illustration, highlight one case which I thought was particularly important, and how important it is that a broker does what is right. Okay. So this very large broker came and said to me that when they are doing KYC of a new customer, one of the first things they look for is to see the age of the investor and the date of the PAN card. So if the age of the investor is, let's say, 40, 45, something like that, and the PAN card is very recent, it's an immediate red flag to them that this is likely a mule account which is being set up for misuse, because a person who is 45 and having first time PAN card, where is the wherewithal for him to be trading in the market? And therefore, most likely, this is a mule account. They turn down the customer. They refuse to open the account. Now, I'm saying there are different brokers. There are some brokers who talk to us about how they are using technology. Some of the larger tech-based brokers talked about how they use technology to identify. So another broker came and told us that they had this client who was just making inordinate sums of money, profit, day after day after day. And he said, statistically, this was an impossibility. We shut the guy's account. Okay, which obvious. So I'm saying this is what brokers are doing today. They are showing great responsible behavior, but we need that to be implemented across the board, because equally the feedback that came on the other side was that while we have all these very good practices, we also have some brokers, a very small minority, but we also have brokers who are constantly colluding in the opening of mule accounts, in the facilitation of mule accounts, and in basically facilitating all the kind of pump and dump that you have been seeing recently. We passed some very interesting orders. So you are being able to see what all is going on. And we are told that, of course, very often, a small minority of the brokers are actively involved in this kind of misconduct as well. So both of these put together have led us to bringing in this regulation. So that is really the regulatory intent, to capture the best practices and also to mitigate collusion. The last item in the secondary market piece is, and well, it could have been in secondary market, it could have been in mutual funds, is a regulatory framework for index providers. So the board has today approved an in-principle proposal to say that we should bring these under the regulation, and certain details are being worked out now. But again, like we said in the case of ESG rating, we believe that this needs to be done sooner than later. Let us not wait for a LIBOR kind of a scandal to break out and then say we need to regulate. Let us make sure that we have a base level of very simple, light touch, conduct-based regulation to begin with. No, no. They just happen to be subsidiaries of the stock exchanges, but there is no provision in our law to regulate them at all, not even one. Yeah, sorry. They are either subsidiaries of exchanges or of credit rating agencies. They are not regulated. We don't have a stitch in place for regulating them. We now move on to the mutual fund piece, and we are absolutely delighted to share the Honorable Finance Minister had made a announcement in one of the budget speeches about a corporate debt market development fund, which was to function as a backstop facility for mutual funds in the event of a market dislocation in the bond market. And we're very happy to share with you that that whole initiative has made a very, very significant progress. And therefore, today, the board approved the creation of a new chapter in our AIF regulations to facilitate the creation of this fund. So basically, what this fund will do is it will sit there on standby and just be on standby in normal times. But whenever there is a significant market dislocation which warrants sovereign intervention, so it has to be really something significant, not minor volatility, but a significant event happens, then just like you have developed markets who instantly trigger asset purchase programs, we will have the ability to, with the press of a button, we would be able to activate this fund, and it would go in there and become the buyer of last resort from the mutual funds. This is a initiative which will be initially funded and the corpus brought in by the mutual fund schemes as well as by the AMCs themselves. So very important to know that the AMCs themselves are putting skin in the game, their own money, not the scheme money, but their own money. So this is a very important milestone, both for the bond market and for the debt mutual fund market. So we hope that this fund will now, so whatever regulations were required to facilitate this have been approved by the board today. And so we will very soon see this backstop facility coming to life. It will be managed by SBI AMC. Seeing the light of day. The next one, again, in relation to mutual funds, there has been a lot of debate and discussion around what is the role of the trustees in an AMC vis-a-vis the role of the AMC itself. And I think that when we had an unfortunate series of events last time, we took a very, very serious look at this and decided that we need to clarify on this. So essentially now what this set of proposals is saying is two things. Number one, it is saying that the principal focus of the trustees is in areas where there is a potential conflict of interest between the shareholders of the AMC and the unit holders of the schemes. That's where you have to focus. So a lot of the procedural and the operational and the tick box stuff has been removed. Saying, please don't bother with it. That's not your job. That's not what we need you to do. We need you to focus on areas where you, as the fiduciary, taking responsibility for the unit holders, you are guarding against conflict of interest with the shareholders of the AMC. So that role is now very, very crystal clear. There are a lot of modalities built in, again, all co-created with industry as to how they are to go about that. In addition, is a very important point which our advisory committee advised us. I must say we went back and forth on it a couple of times, but we finally decided that what the advisory committee was telling us was in fact good advice. And that was that the AMC itself must be given a huge responsibility for unit holder interest and not just as a custodian of the shareholders of the AMC. So now a new committee is going to be formed called the Unit Holder Protection Committee. This will be a committee of the board of the AMC. So the AMC has to own fully. They cannot now say, oh, but the trustees were supposed to look after the unit holder. I was only supposed to look after the interest of the shareholders of the AMC. They can no longer say that because they are required to have a unit holder protection committee and to ensure that they are not compromising. So they are taking responsibility as well for not compromising the interests of the unit holders. Next is an ease of doing business proposal. We had promised to the industry that after 2, 3 years of a lot of regulatory tightening, I would say, um, the evidence of that has been very clear. If you see that, for instance, in the debt mutual funds and in the debt market, given the turn of the interest rate cycle, there has been significant redemption in the debt mutual funds. And despite that, it's been smooth. There's not been a murmur. It's been like a hot knife through butter. There is not been a ripple in the market because the entire industry has taken the whole process of risk management in open-ended funds to heart, and they've truly implemented, if I were to say spirit of the law, this is one industry in respect of liquidity risk management in debt funds. Truly, spirit of the law has been followed. And therefore, we have seen absolutely no problem in what otherwise would have been a huge issue, as we've seen overseas what is happening, SVB Bank, etc. So we had promised the industry that, with all of that that's said and done, we need to and we will need to bring in a lot more opportunity for growth and liberalization. So here it is. Essentially, it is addressed at the core of saying we would like more innovation in the industry, more players in the industry. And there were two things we promised them. This is the first, which is a lot of flexibility in terms of who are sponsors, eligible sponsors for mutual funds. So not only does a whole new category of sponsor come in, which is in the name and nature of private equity as well, more importantly, we are now bringing in a concept of self-sponsored AMCs, which means that when an AMC becomes large enough that in itself it is now eligible to sponsor another mutual fund, then there is no need for it to have a sponsor, and it can declare itself to be self-sponsored, and the erstwhile sponsor can disengage and exit without having to find another suitable sponsor to come in and step into its shoes. So we had said earlier that, in our market, we don't like Abhimanyus. Someone who comes in must have the ability to go out, and they shouldn't get stuck. So the same is true for sponsors of mutual funds. They come in as sponsors. Once their children become mature and grown up, they can exit without having to find a new parent for this grown-up child. So this is a very significant liberalization. The second thing which we have promised to the industry, and which is again next year's KRA for us, is what we call MF Lite. So if mutual fund regulations are 100 pages today, the target to the Sebi team is I want it in 10 pages. And that's going to come for passive funds, because we know that a large amount of our regulation is really around active management. So if somebody wants to come in and only do passive funds, there should be no reason why they have to comply with 90 out of those 100 pages. So only 10 pages will apply. So MF Lite this year is, when I say this year, in the coming year, is what we are taking on as a KRA for the industry. We then move on to um, empowerment of the investors. We have, based on various learnings in the recent past, consolidated a set of provisions. A lot of them relate to disclosure. As you know, we are predominantly a disclosure-based regime. We believe that the real role that SEBI has to play is not to tell listed companies what to do, what not to do. That's not what we have been empowered to do by the SEBI Act. However, the principal role that we play is to ensure that there is full and comprehensive disclosure, and that then with that disclosure, the market votes with its feet, votes with its wallets. So material events, we have brought in many provisions, both for comprehensiveness of disclosure as well as timeliness of disclosure. We also have a set of provisions for empowering the shareholders in terms of their approvals. So things which were sort of considered a promoter's lifelong rights, we are now saying that it is not lifelong, and that you do need to go back to your investors periodically and take approvals. So for instance, special rights granted to any shareholder, including promoters. We cannot have perpetuity of special rights. We cannot have perpetuity of board seats. There was a arbitrage. There was a regulatory arbitrage between scheme of arrangement and sump sale. We've now bridged that arbitrage. So essentially empowering the shareholder to make sure that there isn't a perpetual um, set of rights which the promoters have, which they can take for granted lifelong. Um, there are some more proposals on timeliness of submission and filling up vacancies of directors, largely procedural. And then also some more feedback in terms of at the time of IPOs and bonus issues, there are some procedural issues which we are ironing out. For instance, underwriting. It's very different whether there is hard underwriting or soft underwriting. We are making the rules very clear that if you have an intent to have hard underwriting, it must be disclosed ahead of time. It cannot be done later. Also, in terms of bonus issues, we found that there have been some problems where even before the previous shares issued by the issuer were traded and listed, they came up with bonus issues. Technically, again, letter of the law, there was nothing barring them. Spirit of the law, it was completely wrong. We are now fixing it. We then move on to the debt market, another ease of doing business proposal. This is in the private placement space. We found that there are a large number of issuers who are repeat issuers. And it was completely insane the number of times that they had to file documents again and again and again. And it just didn't make any sense. And therefore, we've now come out with the concept of a general information document, which you file the first time, and the validity is valid for a period of a year. And then every time that you want to do an issue, you just ride off of that and issue and give much less disclosure. Somewhat similar to the umbrella prospectus that was there for public issuances. Based on the consultation that we've done with the industry, we believe that this is something that really would address the ease of doing business. And therefore, if you read our the first para in this carefully, you may get a little bit confused because the penultimate sentence says, the same shall facilitate ease of doing business for the issuers. And then it says, comply or explain, and then mandatory. Okay, so you'll wonder that if this is ease of doing business, why does the regulator need to push anyone to do it? People should do it anyway. So our observation is that there are times when when all the parties involved in a transaction are not necessarily not conflicted, and therefore there are times when even what is right for the issuer is not necessarily done, and therefore we want this comply or explain provision to come in so that every issuer has to look at it and say that if SEBI is saying comply or explain, why am I not looking at this route? Why am I looking at the traditional route? So this is really going to move in that direction. Also, there were some disclosure-related parity issues, which we are also bridging. So that's, again, somewhat procedural. There are two more provisions in the debt market, which are extension of comply or explain. You would know that these were provisions that we had brought in some time back. We feel that given the interest rate cycle right now and given what is really, what is really the context today. So in terms of this 25% incremental borrowing, what we're saying is we're extending. It was a block of 2 years. They were required to achieve something in a block of 2 years. We're now saying that you will have 3 years in which to comply with it. And in terms of certain corporate governance norms, we've gotten feedback from the market on something that we accept is the impossibility of compliance. So there are certain provisions which these companies, it's just impossible for them to comply. So they don't want to be in non-compliance. We are not wanting them to be in non-compliance for technical reasons. So again, going with this whole spirit of what we are interested in is the spirit of the law. We are saying that we will extend this, and in the meanwhile, we will find a solution to the problem of impossibility of compliance. Uh, Item number 15 is in the AIF space. Here we have a number of proposals. The first one is very, very important. As you know, some time ago, we had said that all AIFs need to submit their data for benchmarking, relative benchmarking, so that there is one objective and transparent metric that the entire industry uses to know how the industry is performing and how does each AIF perform within that industry. At that time itself, there had been discussion that while the disclosures have been standardized, the valuation norms are not standardized. But we did leave it for another day, saying we'll come back to this. So we've now come back to it. So again, in consultation with the industry, there are now going to be certain standard ways in which the valuation will be done. Certain standards will be adopted. We understand that most of the AIFs in any case follow this standard informally. So it will now really not disrupt the market. They will just more formally adopt those standards, and they will do that. But it will give us another strength, I would say, in the comparison of the benchmarking data as to who's performing how. We will now have more comparable data than before. The second is in terms of dematerializing the units. We believe that, we've done this in the securities, in the share bazaar, long ago. We all know the benefits of that. And therefore, we feel that this industry also needs to move into that. The first step we have taken today in terms of saying the units have to be dematerialized. Again, next year's KRA, we will be looking at dematerializing the holdings. So their investee companies will need to dematerialize as well, so that both the asset side and the liability side are held in demat. The third one is actually it looks like it's tightening, but actually it's an ease of doing business. We've examined the root cause of why there is often a lot of back and forth in terms of approvals for registration. And one of the reasons is an interminable debate upon the validity of the experience of the staff who are the key persons. So we figured that we need to cut this discussion and debate at the root. So we will now move into a certification mode rather than an experience mode. If you pass the certificate exams, you are eligible, and you will then get your approval much faster. Next one, 15.4, is involving conflict of interest. We already had a provision which was linked to conflict of interest, but we are now expanding it and covering more within the ambit of a conflict of interest, including that if a single investor or a unit holder holds more than 50% of the corpus of the scheme, in a sense, he is also considered sort of a related party. And again, if you deal with him or his associates also, there's a potential conflict of interest, and therefore a separate process needs to be adopted. So this is really to address conflict of interest issues. The next one is, again, very, very important. Given the vintage of many AIF schemes that were launched in the past, they are now reaching maturity. They are, in fact, past their maturity and at the stage where the maximum extension of 2 years is also been crossed. They're in their liquidation period, and time is running out fast. So the issue of saying, what do we do when we continue to hold assets which are illiquid, we cannot get rid of them? What do we do about that? We have worked with the industry, again, co-created a solution. It breaks into 3 parts. One is, of course, if 75% of the people want in-specie distribution, just give it to them. If 75% of the people want that particular asset to go into a new scheme, we're calling it a liquidation scheme, it can go there, but the value at which that sale will happen we are being very clear that that process is going to be followed many ways the most important to us, which is really the strengthening of the investor grievance redressal mechanism. As most of you know, we already have a mechanism which works in the stock exchanges. Currently, it is limited to the processes involving the brokers and their clients. We intend to expand this process in two ways. Number one, to expand it to cover almost all our intermediaries and all their clients. So now there will be this one forum where you can go to and get your mediation arbitration done. The second is to expand the capability of the exchanges themselves, bring in, the professional online dispute resolution professionals who are there, and bring them onto the platform and thereby expand the capacity of the whole thing, including through a hybrid mode. So no need to physically show up in Delhi. It can be done online or through a hybrid mode for those who prefer a physical way of doing it. And last, of course, our budget for next year was approved. So we can all get paid our salaries from April. That's it.
Very seeing in questions. We'll come back to, please ask one question. We'll come back to everyone. It is enough time. So we'll start with Yash, CNBC.
Thank you so much, ma'am, for taking us through this very, very extensive board meeting outcome today. I need one clarification and I have another question. As far as disclosure norms are concerned, of course, there is a mention that introduction of quantitative threshold for determining materiality of events or information. The materiality will be the same as mentioned in the consultation paper, which is 2% of revenue, 2% of net profit, or an average of 5% of your, uh, that's the same thing. Okay. Now, just very quick two questions. As far as total expense ratio is concerned, have you sort of reached out to large mutual funds? There have been instances where the expense ratio is much higher, which has come to SEBI's notice. Have you reached out to large mutual funds? And largely, do you intend to form a very strict policy where these expense ratios can be contained and monitored in that sense? And second question is with respect to a lot of orders which you passed recently. They've sort of had a hurdle when it comes to the legal point. Either it's SAT or Supreme Court which has turned down or reversed those orders. What is going wrong? Is it something with the orders or the way they've been presented? And it's sending a very wrong message to the community. What do you intend to do about that? Thank you so much.
So on total expense ratio, I think you might recollect, we actually for the first time put out a press release in this matter. The reason why we did that was because we felt it was price sensitive information. We have a number of listed AMCs and it would not be appropriate that there is selective disclosure of the fact that SEBI is evaluating the whole process of total expense ratio. It was price sensitive information. So I would only share that what are the 2 or 3 guiding principles of our review, and then in what form and manner it will manifest, you'll need to wait and see until the actual proposals are adopted. But the guiding principles broadly are the following. Number one, that when we say total expense ratio, it should be total expense ratios, no ifs, no buts. But ye upar se, but wo niche se, but wo side se, no bus. It's called total expense ratio. It should cover all expenses. Number one. The second guiding principle is that we have always maintained that there is economies of scale in fund management. So naturally, if your AUM goes from here to here, you do not hire, you do not double your workforce, you do not double. So there is this piece of economies of scale. And it is our belief that the economies of scale are not at a scheme level, but they are at a asset class level. So equity is one asset class, debt is one asset class. Sure, overnight funds is a different asset class, right? So it's an inflated number. We are not going to go with that. That's the feedback we got. We accept it. So the principle is you get economies of scale based on asset class, not scheme level. And the unintended consequence of scheme level was twofold. That SEBI itself, through its regulations, was giving an incentive for fragmentation of schemes, which is not good. That was a very perverse incentive. We have to remove it. Secondly, it was creating a lot of mis-selling on account of NFOs. So that had to be stopped as well. So given this, this is the guiding principle in terms of the second area. The third area, which is somewhat, I would say contentious, but we like to call a spade, is this whole thing of saying that, brokerage should be kept outside of these expenses. And first of all, as I said, it violates the first principle because then it's not total. But equally importantly, we believe that this tantamounts to one of two things. And I say this very carefully. One is either you are double charging the unit holder, because if you are taking asset management fee to manage the asset, then why are you paying such large sums of money to the brokers for the research which you are supposed to be doing? Now, we don't mind. You want to use research of the brokers, we have no problem. I've been a sell-side investment banker myself, so the last thing I want to do is to kill that profession. But you cannot pretend otherwise. Okay, so to us, it was a double charge. We do not appreciate that. The other is that when we examined some of this, we found that there was a distinct possibility, and I say this carefully, that there was a distinct possibility that the brokerage was being paid for reasons other than professional reasons. And therefore, and why was it not coming under anyone's radar? Because the board of the AMC was not looking at it, because it was not coming out of their kitty. The minute you bring it within the total expense ratio, automatically the board of the AMC will ask the question, why are you paying Mr. XYZ broker so much money? Today, no one was asking that question because it was not pinching anyone other than the unit holder. So for both of these reasons, we have taken a call that this is a guiding principle. We will not change from this. As I said, how all of these guiding principles come together and manifest in terms of an actual formula, we will come up with the formulation again in consultation with the industry. We have no desire to, create any adverse impact on the industry, but the principles should be followed. The second thing in terms of the orders. So here I would say three things. Number one, I would say that every order which is current 11 months or the rolling 12 months or some period, she has taken the recent period, and data, 75% is our success rate in the Supreme Court. So which also tells us that obviously the media likes to talk about that 25%, rarely talks about that 75%. So maybe we would request you to do some introspection along with us to help us for the world to know that this is not a regulator whose every case in Supreme Court is getting thrown out. No, that's not the case. 3 out of 4 are being upheld, and the fourth is against us. Now, one of the allegations made against us is that why does Sebi bring so many cases to Supreme Court? Okay. Now, I would like to again give you some data. 46 out of 57. More than three-fourths of the cases which we have taken to the Honorable Supreme Court are cases which are linked cases, which means if we have gone in appeal on one particular matter, and there are other cases in the pipeline coming from there, we cannot not go to the Supreme Court. We have to, because you've appealed it. Now you have to keep going and wait for, and when they get resolved, they'll all get resolved together. The Honorable Supreme Court will clear all of that. So 75% of our cases pending in the Honorable Supreme Court today are linked matters, all linked to one case. So when it gets cleared, it will all get cleared. So this is the data on the table. Perception may be otherwise, and I would request you to please help us correct this perception.
Sajid.
Yes.
Hi, ma'am. Couple of questions on ASBA. You said it's going to be implemented in a phased manner. The first thing, do you have a technical or technology timeline when it will be done? Second, when you say phased manner, you're going to start with cash market and then derivatives, or how is it going to go? Or within the cash market, whether intraday trading or delivery-based trading, how is it done? And secondly, you said that the option will be given to both the investor and to the broker. If the broker doesn't want to do it, how will the investor
Correct.
adopt?
So you're right. Initially, when we had embarked on this journey, we thought we would do it segment-wise. But when the technology discussions happened and the settlement discussions happened, at that time, the conclusion reached was all or none. So it's much easier to implement technologically to say that this client through this broker is coming for ASBA, and even the same client has an option. Through broker A, he comes through ASBA. With broker B, he comes through normal. Okay, so that's sort of the construct that's been given. So therefore, we've abandoned segment by segment rollout. We are going with all or none because it's just easier to implement technologically. The phasing is therefore not in that form. It is in the form of what gets progressively made mandatory. So as I said, right now, everybody has an option. I can go to 3 brokers, do 3 different things as an investor. A broker can say, I offer, I don't offer. Our expectation is that it's a competitive market out there. Okay, broking is not an easy business. It's a competitive market out there. We hope that many of the brokers will implement, and that's what we understand also. It's not just an idle hope. There are at least half a dozen brokers. There are at least half a dozen brokers who've been actively working with us on co-creation, and we believe that they will implement it very quickly. So how we will roll out, maybe we will say, okay, the top 10 brokers have to now mandatorily offer to their clients. We still won't make it mandatory on the client. So in this manner, the phasing will be the level of mandatoriness, let me call it, rather than segment by segment.
One more on the corporate debt fund which has been created. What will be the initial corpus for that fund? And when you are saying that the mutual funds have a skin in the game, will they be doing from their own equity or surplus, or will investors be charged the amount?
Yeah. So the initial corpus is 3,000 crores. And the government has approved a 10-time leverage, so 30,000 crores. This 30,000 crores will be guaranteed by NCGTC, which is basically the government's guaranteeing arm. So it will be a sovereign guarantee. So when the button is triggered that we are in the midst of a market dislocation and we need sovereign support, then this entity will go borrow from the banking system or the repo market or wherever against the sovereign guarantee. So it will now have 33,000 crores with which to go out and be a buyer of last resort from mutual funds. Only mutual funds will be able to participate because they are the contributors, and each of them will be eligible to participate to the extent of their contribution, but it will be at a AMC level, not at a scheme level. So if let's say a fund has contributed X amount at 3,000 crores, let's say 10%, so they will be able to go and sell assets of, if they've contributed, whatever, 300 crores, they can go and access 3,000 crores, 10x. SEBI triggers the button. The SEBI board will trigger the button. A very elaborate model has been built, analyzed, and approved by the government specifically. Of course, all models are meant to be reviewed from time to time because we expect that this is going to be a very long-term facility. So as and when there are fresh learnings, it would be reviewed. But as of today, we have an approved model. That model will form the basis, but not the only contributor to the decision. Then the board will sit and will take various other qualitative and quantitative factors into account based on that model. Model plus other factors, and then decide whether sovereign support is required or not. Yeah. So as I said earlier, that there is the first 3,000 crores is going to come. Yeah. The first 3,000 crores is going to come from roughly from my memory, 10% is coming from the equity of the AMCs, and 90% is coming from the those specific schemes which are going to benefit from this. So not every scheme of the AMC, only the schemes who are going to benefit from this facility. The debt funds. And those also, they are specified debt funds. AMC, the equity. Roughly 10%. नहीं, वो तो था. Out of the initial, that's my recollection. It's not here. Yeah, it's not here, but it's roughly. Paying a very small amount. I think it's a 0.01 or, huh? No, 90% of 10%, bhaiya. No, out of 3,000, no, the real full corpus will be 33,000, no. 3,000 not relevant. 3,000 is not relevant. When you actually want them to come and buy the bonds, they'll have 33,000 crores. The mutual fund investors have only contributed 2,700 out of that, out of 30,000 crores. So it's 90% of 10%. So 9% of the total is contributed by the mutual fund unit holders, 1% by the AMC from their own equity, and 90% by the sovereign.
So, 1 second.
Sorry? हाँ कितना है सर 0.01 something बता देते हैं आपको.
Ajab, is Cornish from Financial Times?
Thanks, Madam Chairperson. Just a clarification question. Why didn't the finance minister address the SEBI board post the budget?
Well, the purpose of the meeting is to look at how it's meant to be an outreach program for implementation of the budget proposals. We had been working so closely with the ministry, and we have already commenced work on the budget proposals. So in many ways, was there a need? Was there a tearing need? There was a lot more outreach programs that the ministry had to do in many parts of the country. It didn't happen. It didn't happen.
Ankur?
I'm Ankur Mishra from ET Now. Just want to draw your attention towards disclosure norms of market rumors to be verified, confirmed, or denied by top 100 listed companies. Is there any timeline for the same? In a point earlier, it has been specified 12 hours timeline. Is there any timeline for this adherence as well?
Yeah.
Yeah, I think it is 24 hours.
Yeah, we'll just check and tell you. It's been stipulated.
Ma'am, another question on financial influencers. Last time when we spoke, you told us that it is a complex issue. Is there any consideration to bring a consultation paper on the same, or the work has begun?
Next year's KRA.
Mahalakshmi?
As you can see, we are accumulating KRAs left, right, and center for next year.
Ma'am, and last question on the trustees' oversight on AMCs. One point is mentioned that fairness of fees and expenses to be there for trustees to see. How will that be quantified? Will it be only qualitative?
No, no. अरे fees तो एक number होता है भैया, rupees crores. Nothing can be more quantified than fees. So the question is, let me put it this way. In theory, and this is what we are trying to emphasize here, I'm glad you picked up on it. In theory, the construct of a mutual fund is there is a trustee. He decides that all this money is here from the retail investors, other investors. Let me find a good fund manager for this money. That's what it's meant to be, right? That's not in reality what happens. That's how it's meant to be. So we are trying to now ensure that the trustees see this role of theirs and say, okay, this money was with you. Very good. I am the fiduciary for the unit holder. Now, let me see how well you performed vis-a-vis your peers, how well you performed vis-a-vis benchmark, and how much did you charge me for it? So if you are underperforming vis-a-vis benchmark, vis-a-vis peer, and you're charging me a ton of fee, the trustee is supposed to say, I don't like it, please reduce your fee or I'm going to another fund manager. That's how it should be. That's the legal construct. So we are now emphasizing to the trustees, please play this role. Please evaluate whether the fees that is being paid is appropriate, not appropriate compared to peers. Okay, you are supposed to look after the unit holder. If somebody is charging the max cap, I don't know what the cap is, 2%, something. Okay, and every other competitor is charging 1.5%, and you're underperforming those fellows, why am I entrusting you with the money? One good reason. So this is what, that's what I'm saying. The sharpness of the role now is, of course, the AMC would like to maximize fees for its shareholders. And many of them are listed, so we have full empathy for them. We don't say that's a bad thing. They are trying to do their job. But what about the unit holder here? Who's watching out for him? So this is the balance which is sought to be now made. So yes, henceforth, trustees will be expected to demand to see the performance of the fund manager vis-a-vis benchmark, vis-a-vis competition, evaluating whether the fee was justified, not justified, why is so much being paid, X, Y, Z.
Mahalakshmi?
Yeah, so that 24 hours from the reporting of the report.
This is Mahalakshmi.
Again, one more clarification. Has, when we do stories, we definitely write to companies. Now, this is also part of that. Is it that somebody has reached out to the company, or from that timeline you have to report within 24 hours, or sometimes if there is, as you mentioned, market rumor, it is already there in the market, floating in WhatsApp groups, or it is there on some website. Again, has that been also identified?
You have defined mainstream media. Please come in any of the mainstream media. They have.
We've defined mainstream media. That was one of the feedback we got in the consultation process, that please don't leave it vague because there's a whole digital world out there. Some random person somewhere is publishing something. So we took that feedback as constructive feedback. We have clearly defined what we mean by mainstream media. And then when it comes in that mainstream media, from there you have to respond.
Yes, Mahalakshmi, please.
No, I think we have said from it being published.
The moment it is reported in any of the mainstream media within 24 hours, they have to verify, confirm or deny.
Yes.
आप खुश हैं कि दुखी हैं? हाँ?
Yes, Mahalakshmi, please.
Yes.
This is Mahalakshmi from Money Control. Hi, this is Mahalakshmi from Money Control. So, ma'am, both these things that have been talked about so far, one is the ASBA and earlier shorter settlement cycle and the total expense ratio. All of these augur very well for retail investors, unit holders. The collateral damage out here seems to be the brokers. On one hand, discount brokers absolutely don't make any money. That's a different story altogether. But
Which one
except
are you looking at?
Okay.
I'm not
so
looking
a
at
whole
the
of-
same discount brokers you are looking at,
Okay,
Mahalakshmi.
So a significant part of even that money comes from float. Now, this negates any possibility of float income for most of the brokers. Secondly, last year, if you see the total turnover of mutual funds in equities was about 20 trillion. So which means about 3,000 crores the broking industry gets from the mutual fund industry, which is a large kitty now. That's almost 50% of what the broking houses, the entire industry makes. Now, in your mind, how do you see brokers and this broking industry really evolving? That's question number one. Second is the fallout of this total expense ratio is also that small and mid-sized funds might find it really challenging because right now they're drawing from a pooled resource base, which is the sell side in terms of research. Because even if you have a small, even if you don't have a small cap fund, you at least need research coverage on 300, 400 companies. So how do you see that space evolving? Because this seems to perpetuate, I mean, the perverse outcome of this could be perpetuating the competitive edge that the larger AMCs would have over the mid and smaller companies.
Okay. So, two separate issues, we'll try and address them separately. So, first of all, the discount brokers are making a lot of money. If you look at their P&Ls, Mahalakshmi, they're making a lot of money. Okay, why? No, why? 20 rupees a trade, if there's a compulsive trader who's trading in, out, in, out, in, out, in, out, and we've published a report for all of you to see, the numbers are obvious. So first of all, let's be clear, people are making money. Okay? Now, the question is...
Even now, a significant part of it also comes from...
No, I'm coming to float. So first of all, the upstreaming of the funds, which we referred to, the benefit of the float at this stage of the proposal will still go to the broker. Right? So as I said, we co-create. We don't like jhatkas in the market. We do things smoothly. So there is no resistance. Why is everyone supporting us? Because they are getting their float income still the way that they were up to now. The question you asked is, how is this evolving? Now the question is, when you move into ASBA-like, okay? So I'll take you back in time since we were both around when ASBA came in primary market. What was said? Oh, the issue expenses will shoot up because now this float income, the bankers to the issue were doing things for free. On the back of the float income, investment bankers were doing things for free. Now the cost of issuance is going to go up because all this float is going to go away, right? We've heard this story before. We've seen this movie before, right? So what did Sebi say? We said, but where did we say you shouldn't make money, bhaiya? Just unbundle it. What we don't like is hidden costs, okay? And more than hidden costs, we don't like risk. To be honest, personally, and I'm speaking personally, this is not the Sebi view, but personally, I actually don't mind bundle costs. Bhai, hota hai, cross subsidy hota hai, that's how business is. What we don't like is the risk. We will never allow another Karvi in our market, period. Period. So there is nothing we will not do. Over our dead body, there'll be another Karvi. That's clear. Okay. Now, if in that process, the brokerage costs have to be unbundled, float separate, fee separate, so be it. It happened in IPOs. Did the world come to a collapse? No. People adjusted. They said, okay, there is this, float completely vanished. Everybody started charging what they needed to charge. So where is it evolving? It's evolving to a more transparent, unbundled method of fee charging. And both investors and intermediaries will get accustomed to it the way that they got accustomed in IPOs. The second, in terms of the TER, actually, let me tell you, the maximum resistance and petitions we are getting are from the larger mutual funds, because we actually at Sebi are very sympathetic. Sorry, so one of the principles I forgot to articulate. Remember, I articulated some principles for the TER. One of the principles we've communicated to the industry is we want competition. We will not allow a schema which will go against small AMCs. So if you see, all the petitions that are coming from the big five, big seven, big eight. Okay, small people are not coming to us. They know we are protecting them because we want more. It's a job of a regulator to make sure that there is more competition in the market, not less. So you will see as the schema evolves that there is a lot of protection to the smaller funds to allow them to settle, get their feet stable, make profits, etc. Okay, so I don't think that there's anything. As I said, the evidence, proof of the pudding is I have not got a single person meeting me from the bottom 10. I've got